Welcome to DWS Market Update. Since reaching their highs in early summer, many markets have seen falling prices. In the case of global stock indices, the decline from the peak so far amounted to around 10%. Geopolitical risks might have played a role to some extent. However, since the oil price, which is considered an important indicator for geopolitical risks, has been relatively stable, this is probably not the only reason for the decline in stock markets. Another factor that does not support the view that geopolitical risks are currently dominating the markets is the fact that US government bond yields have not declined. Usually, investors looking for a safe haven tend to buy sovereign bonds, hence driving yields lower. This time, bond yields have actually gone up, which, however, brings us to one important negative factor for equity markets. For a long time, stock valuations well above the historical average have been justified by extremely low yields. Thanks to the rise in yields, however, fixed income securities have once again become an alternative to equities. In addition, the sluggish global economy is currently causing some weakness in corporate earnings. Taken together, it seems that markets were probably priced for an overly positive scenario. Inflation under control, central bank policy rates having reached a peak, and the economy holding up well. That would have been needed for such a perfect world. Or as one colleague has put it, equity markets were priced for perfection. Now, a sense of reality seems to be back in markets. The good news is that after the recent declines, many stock indices are back in a range that perhaps cannot be yet described as overly cheap, but which is once again in line with our forecasts. In this respect, it might well turn out to be a healthy correction. That's it for today. Thanks for watching and goodbye.